Good day, ladies and gentlemen, and welcome to our class on using candlesticks the right way and candlestick trading. Please hit the subscribe button down below and subscribe to my YouTube channel. It's very important for us. I promise you, we're not going to do anything. We're not going to get in touch with you. YouTube will just notify you when we upload a new video. So please hit the subscribe button. That's all that we ask. And please also make comments when you're there. So, although there is extensive literature on Japanese candlesticks, most of it is generally vague and does not provide any statistical evidence on the validity of patterns. Japanese candlesticks were initially developed in Japan around the 18th century and used by Japanese investors to forecast the price fluctuations of rice. Although Japanese candlestick charts have been used in Japan for over 200 years, they were virtually unknown in the West until 1990 when they were introduced by Steve Nissen. Following Nissen's introduction and the rise of the World Wide Web, Japanese candlesticks have enjoyed increased popularity. Today, they are commonly included in most software packages and websites for technical analysis studies of stocks, commodities, indices, ETFs, cryptocurrencies. Japanese candlesticks work for every market and every type of instrument. Now, we are not, I'm sorry, we are not going to spend much time on candlestick pattern recognition. For most of us, in our kind of trading, this is contrary and dangerous. Memorizing patterns and what they should do when one appears is not good for trading. Okay. When the markets were slower and things eased along, and especially when you're looking at just the stock market, these patterns had time to form and you had time to do these evaluation and trade as the rules said. But rule-based trading is never good for any of us because we get stuck in the rules and don't look outside our little box. Now, many studies have been done to answer the question, are Japanese candlesticks an effective tool for forecasting future price action in the markets? The rising trend in candlestick trading has led to a sharp spike in the number of technical traders signing up to use them. The reason behind the surge is that candlesticks are quite versatile, and many believe that these patterns' reliability indicate future positive or negative price swings. Now, not all candlestick patterns are reliable, but some are, and these can form part of your trading strategy. However, the reliability of candlestick patterns can vary a lot depending on the market you trade in, the time frame, and other related conditions relevant to your overall trading strategy. Candlestick charts rank high among the most favored and widely used price charts in the market and provide you with valuable information on price movement in a given time frame. But more than that, a single glance at their colors, shapes, and patterns show you all that is currently happening in the market. Candlestick charts rank highly among the most favorite charts being used. Candlestick charts consolidate data from a selected time frame into a single candlestick bar. In other words, they take the open, the high, the low, and the close and combine them into one bar, one easy shaped candle that shows that whole time frame. And you can also see if it was a bearish time frame or a bullish time frame. But it's looking at the candlestick as a price and the movement of price that's important to us. Now, to read candlesticks, you need to check its color, its body, its wicks. Different parts of the pattern tells a different story, and while the shapes, colors, or direction can appear random, sometimes several candlesticks join up to form a pattern. The candlestick patterns can reveal bullish or bearish sentiment in the markets and help traders confirm their forecasts about market movement. So we're always looking at the body, the wicks of the candle, and the position of the candle. and this helps us in our price analysis. Traders who have experienced marginal success with trading using candlestick trading patterns fail because they wrongly assume that every pattern follows a similar path and that the pattern forms due to a single action, such as selling or bearish pin bars. Studies carried out on the effectiveness of candlestick patterns seem to agree that overall the patterns have a success rate of 50% of the time. Well, if we got 50-50 time of success, it's like having nothing. 50% right, 50% wrong. As such, traders need to learn how to determine which patterns are likely to turn profitable and which ones will end up losing your money. Since candlestick shapes and patterns provide valuable information regarding what transpires in the market, you can use this info to try to forecast future price happenings. The patterns could signal potential market reversals, while others might indicate a continuation of the current trend. This can be a great help when analyzing the market, and it explains why some price action traders leverage the chart patterns when doing their technical analysis. Okay, using chart patterns, using candlesticks is great. I trade from candlesticks. Using them as part of your strategy, as part of your overall analysis is great. Looking for predetermined candlestick patterns through what we call pattern recognition. Is every time I see a hammer, I'm supposed to do that. Every time I see a bullish engulfing or harami or marabuzu, I'm supposed to do that, or this is what is going to happen. No, it's candlesticks can make up a good part of your technical analysis. I use candlesticks in conjunction with support and resistance and chart patterns. Triangles, I'm a big triangle and support and resistance trader. And I look for the relationship of the candle and the wicks to these levels, as well as looking at the body or the width of the candle and using those candles to determine my stop loss or my risk management. So several factors highly impact the reliability of candlestick patterns, but you can trade with more confidence if you take note of them. Just note. These factors are the time frame. Short time frames tend to be less reliable than long ones due to the higher volatility experienced because trader sentiment is prone to more frequent changes in the short term. In other words, most of us are short-term traders. I'm not going to use the word day traders because we're not stuck into closing our trades every night. But we keep our trades open for a day, 2 days, 3 days, maybe a week, but not much longer than that. Trading from a head and shoulders pattern, which can incorporate a huge amount of candles, and it's a slow pattern to unfold, just doesn't work for us. We also want to look at the instrument we're trading. Trading instruments behave in different ways, but what's crucial is the traded volume or liquidity. Some candles work for Forex, while others work better for stocks. But overall, the higher the volumes dealt, the more reliable the candles will be. Consider the chart pattern. Consider the environment in which the candlestick happens. In other words, look at what is going on in price action. Understand maybe moving averages, maybe support and resistance, trend lines, chart patterns, and the relationship of that candle. If there's support and resistance lines close by, the trade has the potential to work out. Look at the overall pattern size. The larger the pattern, the more reliable they tend to get. Also, significant price movement will give out stronger signals. And when we're talking about price pattern, we're not talking about candlestick pattern. We're talking about price patterns. And then we have the candlestick pattern. Different candle patterns have different reliability levels, but in general, the more candles a given formation contains, the more reliable it is. The downside is that this doesn't appear that often. It's important to point out that you don't have to memorize candlestick formations to understand the price movement. This is the common mistake, and I keep reiterating, that new traders make. Instead, learn how the markets work, and you'll be better placed to use your trading tools like the candlestick charts. Sorry about that. Candlesticks tell us a story about price in general, whereas the candlestick pattern informs us about something specific, a warning perhaps. Each candlestick reveals information about the development of the story, and this is what's important to us, the story of price. But it's the pattern that makes us traders alert for potential trading opportunities. The story unfolds on multiple time frames too. In trading, it's always good to make multiple time frame analysis to gain an understanding of the entire story, not only one chapter. For example, if a candlestick pattern appears on a higher time frame, then it can be a benefit to enter the market in lower time frames. That way we can improve our risk-reward ratio and we can get farther confirmation or cancellations of trades. Now see this chart that's on your screen. Here we've looked at a whole long history of an asset. Okay. We go back over many, many candles. But when you're looking at your chart, okay, you need to be able to tell the story of price, not just exactly what's happening on the right-hand side toward the window, because you can only trade going this way, but you need to be able to tell what's happening and leading up to it. Okay. So like here, we can start at the left. And we can notice the doji high and the doji low became at the support and resistance levels. Price went above and then below the resistance and support line, but it did not manage to close beyond support and resistance in level 1. So you see here, okay, we have our support and resistance. See, we can analyze what's happening here with our candlesticks and look at the closes and the opens we have right on our resistance zone and how it's breaking down and staying above our support zone until we get the final breakout. Okay. Now, here the fact that we had a dragonfly doji and then another doji is really insignificant. We notice them. But now we start a downward movement once we broke our support zone. And look at this, we're going down, 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 the price moves up. And what do we get? We get a shooting star. Okay. A shooting star might be a continuation pattern. It might be a reversal pattern. Okay. But we saw the shooting star directly at our moving average. And what did it do? The price continued its downward trend. Down here at the very bottom, we see a hammer. We also see a very, very long white candle. And price reverses and starts moving up. And we can see there's a whole story that we can explain about the asset we're looking at. And when we can explain that story, we can understand what price is trying to tell us in the long term, the short term, and for our trade. So here we have the downtrend continues. And look at this. This was a perfect trading opportunity. We break our resistance level, come down to our support level, bounce off our support level, break our resistance, and we move into an uptrend. Okay. And we can see this beautifully with the wicks of our candles and the body of our candle here, and then the close of this body of the candle above the resistance zone. So being able to read the price of the story of price, and each time one of these significant things happened, we got signals. And these signals gave us excellent trading opportunities. Using support and resistance in candles gives us a wonderful way because we can judge momentum. We can actually see a price moving down to a support level, and we can see the price movement putting the brakes on. We can wait for it to make a sideways turn or a reverse turn. But there's a lot to tell us by looking at the bodies. Again, the smaller bodies are showing us, as we're going from larger bodies to smaller bodies, that we're seeing the brakes being put on. Now, there are many ways to use candlesticks to find opportunities. Again, the loss of momentum. The loss of momentum shows here we see buyers in control, smaller pattern. Buyers are still in control, but losing some of the strength. Again, as we're moving up to that resistance line, we still have the buyers in control, and we're still moving up. We still see green candles. Okay. But now when we get close to resistance and actually We hit resistance because we can see our wick going up into resistance. Okay. The buyers had no more momentum. The sellers came in rejecting the higher price, and sellers took control. Okay. We see all this with our candles. We can use candles in our wave patterns. Okay. We can use it in wave analysis. And then, of course, we can use it in our support and resistance, which is, like I said, my favorite way of using candles. And then we have bearish spikes and bullish spikes, which really help us see a potential for the moving price of the change of the price of candlesticks. Classic use of candlesticks without any memorization of names, pattern recognition. Okay, just looking and understanding what that candle with its body, its wicks, its green or its red are trying to tell us. Now, Japanese candlesticks are a very useful tool to dissect both past and current price action on the time frame of your choice. However, it's important to add some fundamental analysis to your toolkit and look at economic and political and financial trends that might impact the performance of the asset you're analyzing. For example, if a cryptocurrency explodes in value due to an upcoming airdrop or promotional event, it would be irresponsible to buy high and expect that price to just continue going up. Taking a measured approach to day trading and utilizing techniques like dollar cost averaging, where you buy at specific intervals, could make all the difference over the course of a month or year or day. So ask yourself, if you could, would you rather earn an extra $10,000 of trading or save $10,000 by eliminating some bad trades over the course of a year? Surprisingly, both yield the same results on your bottom line. So if you familiarize yourself with, if you're familiar with Japanese martial arts, like karate or aikido, you'll know that defense is as important as attack. Remember this the next time you slide in front of your computer and start drawing lines across these candlesticks.